Hello friends, a very warm welcome to Canara Robeco Connect program. I am Gaurav Goyal and I am in conversation with Mr. Avnish Jain, Head of Fixed Income, Canara Robeco Mutual Fund. Welcome Avnish.
Thank you.
So Avnish, I think the very big event in US is the Trump 2.0, and how do you see that impacting the monetary policy there in the US and therefore its impact on the interest rates across the globe?
Thank you, Gaurav, for the question. And the way the market is behaving right now, they have discounted a lot of Trump policies, which he's already kind of announced well in advance. Three main planks on his agenda are: one, tariffs on few nations; second, he wants to cut corporate tax rate; third, he wants to build a wall to keep out immigrants. All these agendas will impact US and the global trade in some way. Tariffs will likely increase some costs for imported items in US. Stopping immigrants would increase the labor cost in US, so that could impact inflation. Thirdly, obviously, the corporate tax rate cut could keep the fiscal on the higher side. But you have to remember, on the other side, he also have another department called Department of Government Efficiency, or DOGE, which they intend to cut $2 trillion in federal expenses. These kind of things are contrary, in my view. I think there's a lot of noise, and action on ground will be seen only after 20th January. What he can achieve in a short period of time and what will be drag on through the Congress and the Senate. I will just take a step back and look at what happened in 2016 when Trump first came to power. That time also yields and US dollar climbed up after the election till he was thrown in. After that, if we look at the dollar index, it actually went down. Because Trump actually believes in a weak dollar, it doesn't believe in a strong dollar. Also, Trump believes in lower rates. So obviously, that's why he kept saying that I want a say in the interest rates. I want to cut. Last time also, though he had appointed Jerome Powell as the chair of the Fed, he had, in fact, after 1.5 years, he was poking him for cutting rates. So I think from that angle, Trump policies may not be that bad as it seems. I think market is overtly negative on the rates right now. Obviously, the Fed also has to do something with it. But I think Trump policies may not be as harsh as they seem now, because there is a lot of ground to cover in the Senate also, and also in the Congress, where a lot of people may not be for his policies. So it will be uncertain times till he is elected and things become a little more clearer.
But if you look at in terms of the recent, Fed policy announcement, and from a next year, perspective, they have already reduced, the prediction in terms of forecast in terms of only 2 rate cuts now of 50 basis point.
Yeah.
So how do you see that? One side, while, as you have been arguing that Trump would want the lower interest rate, but is the Fed, looking at something else there?
So when in the last policy previous in November when Trump was elected, and immediately afterward there was a Fed policy, Powell said that what policies are not in existence will not impact their current rate setting agenda. However, people believe that in December policy, lot of members have kind of put in their models what tariff hikes or loss of immigrants or corporate tax rate cuts, they have incorporated in their models. So obviously they are taking into account what can happen in like 3 to 6 months, and accordingly doing the projections of rates. Because of that, I think another thing is, without Trump also, the US economy is growing strong at 2.8%
Correct.
per quarter. Yes. Also, inflation is stuck around 2.5, 2.6 levels. It is not coming down as anticipated earlier. They had anticipated it to come to around 2% probably by end of 2025. Now they are expecting around probably 2.5. So they expect the inflation to remain flat. That has also taken off some of the rate cuts off the table. To that extent, it is possible that a 50 basis rate cut or 75 next year. Now they are projecting 50. But things can change, as we know, policy to policy.
Yes.
So we have to wait and see what will happen after Trump is elected, and the next policy is probably in January, just after the Trump swearing in. So we'll see what he does there, the Fed does there.
Sure. Also, Avnish, I'd like to understand from you, when you look at the bond yields in two markets, when you look at the US market and the Indian market, and when you look at the actions taken by the respective central banks. So on one side, we see the Fed has actually reduced 100 basis point reduction in their rates in 2024. But we have seen the US 10-year yields actually going up, by at least 70 to 80 basis point. While on the other side, when you look at in terms of the Indian central bank, there has been no cut. But when you look at in terms of the 10-year GSEC, it's already from about 7.25 to 6.75, 6.8 kind of range. So there is some kind of, without any rate cut, we have seen the easing there. So how do we understand, these two dichotomy?
So yeah, it is counterintuitive, but it is simple that market discounts rate cuts well in advance. So when the US yields fell to 3.6%, there was anticipation he will cut 100 basis this year, and Fed will cut 100 basis next year also. Now, during the interim period, the next between 3 to 4 months, the expectation of future rate cuts have gone down from 100 basis in 2025 to 50 basis in 2025. So market is accordingly pricing in a lower rate cut, lower number of rate cuts next year, and a higher kind of neutral rate, what they call there, where the Fed would probably stop cutting because it will match with the inflation target.
Okay.
In India, it is different. I think India rates are also down on two factors. One is obviously expectation was always there of rate cut. Second is that we saw huge inflows because of inclusion in the JP Morgan index.
Okay.
So last year we saw approximately $17 to $18 billion of inflows. I think that is what actually moved the needle on rates. Otherwise, I think our rates could have been at 7.25 or so if it not was the JP Morgan index. Thirdly, obviously, government fiscal deficit also has come down over the years. So that is also helping markets by reducing the supply.
Correct. And they are seeing a commitment from the government in terms of the
Yes. So last 3 years, they have seen a commitment from government to actually undershoot the target they were setting themselves.
Yes.
And next year also expectation is of 4.5% fiscal deficit as percent of GDP.
Correct.
So to that extent, I think it is good for markets. And government also, the rates are down, I think a combination of what factors I talked about.
Sure. So coming back to, the state of the Indian economy and the recent RBI monetary policy decisions which they have taken. So one is, of course, RBI has increased their projection for the inflation. They also reduced their projection for GDP growth rate. So we have a slowing economy at this point of time, and we are witnessing a higher inflation, and therefore, there was a pause on no rate cut, but also, a beginning in terms of through a CRR cut which has happened. So do you see this as the beginning of the easing of the rate cut cycle in India?
I think earlier RBI, before this policy, RBI was sitting pretty, considering that growth numbers were strong and inflation was coming down, and they could hold on to not cutting rates for a longer period of time to ensure that inflation falls to 4% target.
Correct.
Inflation has been higher because of mainly food prices. If you look at core inflation is less than 4%,
Yes,
3.7, 3.8%.
True. Headline inflation is higher.
Headline inflation is higher because of food prices. It is likely to fall probably in December and January. Typically in winter months, the food prices come down sharply and the inflation consequently also comes down sharply. Now coming to RBI's decision, obviously now they have to factor in the growth equation.
Growth dynamics also.
Yeah, growth variable as well.
Correct.
Growth sharply slowed down in 5.4% from 6.7 in Q1. Q2 was 5.4. While they are, I think RBI is still standing strong and saying, no, this is the kind of low, it will be the bottom kind of growth number, and we will see 7% in second half. I think I want to take it with a pinch of salt. 7% sudden growth rate may not come in, but yes, mid 6% growth rate is still possible. So growth will be a challenge for RBI in the next policy. By that time, corporate earnings numbers will come out. Most of the large corporates will declare. You will get a sense on what kind of growth is on the ground. So this time also, markets were participants were kind of knew that growth number will be lower because corporate earnings were slightly weaker. Now, because of the festival season in November, it is possible that numbers will be higher. Also, government has committed to spending more. They have not spent so much in the first 6 months. So there will be bunch up of spending in the third and fourth quarter, which may boost the GDP number. So, but RBI will have to look at those numbers. Now they have to factor in the GDP variable, which they were kind of ignoring because it was quite good.
Correct.
So again, in the next policy, they have to factor that GDP variable also with inflation and look at a picture as a whole. A third thing which is also impacting, which is like a wild card, is the rupee value.
Absolutely.
So rupee has also gone above 85 for first time, 85 to the dollar. But that is because dollar strength is happening world over. Dollar is strengthening in the last 2 months. It has so all the major currencies have weakened against the dollar by actually more amount than our currency has weakened. In fact, rupee has kind of outperformed most of the Asian currencies. Most of the Asian currencies. Yeah. To that extent, we need not worry too much about rupee. RBI, I think, will look at growth number because government is also worried that growth should not take a backseat in fight for inflation totally. Mandate to RBI is growth and inflation, I guess. So from that angle, I think RBI will have a difficult job in February policy to decide if inflation number does not fall as anticipated. If it falls, then RBI can take a cue from that and possibly move on a actual rate cut.
Easing cycle.
Yeah.
So, Avnish, when you look at in terms of 2024, and when you look at in terms of from an investor's return experience across different strategies, so clearly there is a very narrow spread if I have to look at in terms of investors, those who have invested at the short end or at the long end. So clearly from a liquid fund to a long dated bond or long dated gilt securities which they have invested in. From 2025 perspective, what is your view in terms of this spread is going to get a substantial differential in terms of the return experience? And second is that what kind of strategies would you recommend to investors and partners both at the short end and the long end of the curve?
So if I recall, I think last 1 year return, if we see probably YOY, I will see 1 year return. I am not seeing FITD. So I think most of the duration funds are given close to high single digits, like close to 9%. Liquid would be close to 675 to 7. So there is a 200 basis point difference in returns, which is acceptable considering that the duration of these funds were very high. What we will see is now going forward, because the situation is uncertain, your rate cut cycle now is dependent on two factors. One is growth numbers and your inflation expectations. Thirdly, you have to also look at flows, what kind of flows India will get after JP Morgan is more or less probably 75-80% money has come in and 25-30% is left. But there is also Bloomberg index money coming in, and next year from June onwards, FTSE money will also come in. So flows are lined up to come to India. So putting all these factors, I think one could expect probably not 200, but at least 100 to 150 basis kind of return over liquid. Liquid returns will drop because once the rate cut happens, your rate automatically overnight and very short-term rates drop drastically. But a rate cut will help funds like savings funds, ultra short duration fund, because the 1 year curve has been on the higher side throughout this cycle. The 1 year curve, especially it's 1 year, 1.5 year, 2 year rates have been much higher than say 5 year corporate bond, basically on the corporate bond curve.
Correct.
The 1 to 5 year is inverted, 5 to 10 year is inverted. So 1 year and 2 year rates are kind of the highest on the curve. And the money market fund and the short duration fund, which are investing in this kind of categories of instruments, mainly in the probably 6 months, 1 year, 1.5 year, 2 years mostly, they will likely benefit if rates are cut. Liquidity is another issue. Right now, liquidity is a bit tight, but we will have the second tranche of CRR hitting us by this weekend.
Correct. Yeah. By
The
28th.
the liquidity should improve, and I think short-term rates should come down in the next 1 or 2 weeks.
But so what you're saying is that definitely at the 1 to 2 years, since it is inverted, it makes a lot of sense in terms of investors to look at the allocation at the funds like savings funds and ultra short term, which can actually capture those kind of bonds.
Yeah, over medium term, I think the curve should mean revert to a normal curve of being a steepening curve. Like 1 year is lower than 3 year, 5 year, or 10 year. Once the rate cut happens, that will play out. I think 1 year will drop much more than probably a 5 year or a 10 year.
No, certainly, I think with that inverted curve, there is a
extra
opportunity.
Drop will be there in the reels. Say 25 basis rate cut happens, then 1 year may drop by 50 basis points, for example. And long end may drop by 10-15 basis points. So to that extent, the short end of the curve can give much better returns over 6 months to 12 months time frame. Long-term funds, I think, are good, especially from 12-month to 18-month period, because we are still seeing the rate cut cycle playing out.
Correct.
I think growth numbers will slowly slow down simply because government is going for fiscal contraction. Globally, we are seeing rate cuts happening, but that impact is still not being felt. I think there is a lag between a rate cut and transmission to the real economy. US will reduce their rate cut expectations in next year, so that automatically will keep growth a little, slow down a growth a little more. So from that angle, I think long duration funds will still lot of play left for the next 12 to 18 months.
And if I can ask you, what is your expectation in terms of if the rate easing cycle begins?
So my expectation is February. I am pretty confident that a rate cut may happen. One is because growth numbers, I think, probably surprise on the downside rather than upside. Second is inflation is likely to fall in December, and RBI will only have one number before going into the policy. So that is a thing, but they will have a sense of what numbers are coming by February 6th or 7th when the policy is there. Budget is one thing which could make or break rates, but government has been positive on the budget always, and they have been sticking to the FRBM glide path. So we do anticipate that the finance minister would keep 4.5% fiscal deficit target for FY26. So given that, I think RBI may be given the chance to cut rates in February, and I think if February happens, then April is also a good chance of a rate cut, second rate cut follow-up rate cut coming in April.
So even what you're saying is that investors, those who are looking at allocating at the long end of the curve, like funds in gilt fund and dynamic bond fund, they can start looking at in terms of
Yeah, they can still start looking at that. Though we have seen some part of the cycle play out, I think still this is a long kind of cycle which will be there. Not like previous times when the rate cut used to happen over 6 to 8 months and 1 year, and the market then used to plateau out and nothing used to much happen. Nowadays, it is because of the play out of growth and inflation. The cycle is going to be a drawn out cycle. US also will be much slower now going to next year or next year after that. To that extent, you have a longer time to play on rates, and markets will also have, markets will not have to be very volatile to digest a sharp rate cut or a sharp rate hike.
No, thank you so much, Avnish, for this insightful discussion. What you are saying is investors, those who are looking at investment in fixed income, they can have best of both the worlds by allocating both at the short end of the curve and at the long end of the curve. Yes. Thank you so much, Avnish.
Thank you, Gaurav.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.